All right, we're going to go ahead and turn this over now to Mark and get started. Mark, if you click on the screen, you should have control.
All right. Well, thanks, Amy. Thanks, everyone, for your attendance today. And we will talk about some tax incentives that are available for exporters. Primarily, there are two major export incentives today. Those include the interest charge Domestic International Sales Corporation, which is commonly known as the IC-DISC. And the other one is the Federal Derived Intangible Income Benefit, shortened as FDII, which came about from the 2018 tax law. So we'll spend most of the time today talking about the IC-DISC benefit, and then at the end we'll touch on the FDII benefit. So for the IC-DISC, we'll start with just talking about kind of what it is and how it can fit into your ownership structure. Then we'll talk about who qualifies for it. We'll talk about some commission calculation methods, and then we'll wrap up with the discussion on the FDII benefit. So first off, an IC-DISC. In general, who qualifies? You'll hear it commonly referred to from the perspective of manufacturer of US goods that are going to be exported. But it's important to note that many people, many industries outside of the manufacturing industry can also benefit from an IC-DISC. This includes companies that are in the agricultural industry, the mining industry, service providers who provide architectural or engineering services for construction projects that are outside the US, as well as distributors. Companies that just distribute qualified export property can also benefit from an IC-DISC. There are two types of IC-DISC that are available. The first type is the commission DISC. This is the most common type and will probably involve most of our discussion today, or all of our discussion today. The commission DISC, legally what happens is an IC-DISC enters into a commission agreement with its related supplier or the manufacturing company or the exporter. And this commission agreement basically states that the IC-DISC for a commission will help facilitate the export transactions of the related supplier. But essentially, what happens is the IC-DISC does nothing. It's a paper entity. It receives a commission based on the exports of the related supplier, but it doesn't really do anything. The second type is a buy-sell DISC. The difference between a buy-sell DISC is that it actually receives title to the export property and is the seller of record. But this type of DISC is not commonly used, and we won't really talk about it today. So why would we want to use an IC-DISC? The primary benefit of an IC-DISC is that it provides permanent tax savings. And the tax savings kind of differ based on whether you are a pass-through entity, relay supplier, or a C corporation. So if you're a pass-through entity, what you are doing with an IC-DISC is you are basically shifting ordinary income into qualified dividend income as a result of paying this commission to the IC-DISC. And it's hard to pinpoint what the exact tax savings would be in a pass-through entity structure, just because individuals are subject to ordinary tax at marginal tax rates. And so if we were to assume that the ultimate individual taxpayer receives the full deduction under Section 199A, which is a 20% deduction on pass-through income, assume that they are in the highest marginal bracket individually, so that would result in a 29.6% effective ordinary tax rate, and then let's assume the individual is subject to 20% capital gain tax rate, plus the 3.8% net investment income tax, so that's 23.8%. That would give you a 5.8% tax savings if you take the 29.6 less the 23.8. But if the individual is in a different tax rate than the 37% ordinary, the 20% capital gain, that tax savings will be different. The C corporation the benefit, you get the tax savings because you're avoiding double taxation on the IC-DISC commission. And this could potentially allow for up to a 16% tax savings. And I'll show some illustrations of these structures and put some numbers to show how we get the tax savings. A secondary benefit of an IC-DISC is that you can defer income tax by having an IC-DISC structure within your organization structure. Deferring tax, we'll talk about that a little bit later on in the presentation, but note that if you do defer tax, you are subject to an interest charge. That's the IC and IC-DISC. So let's look at the examples of the ownership structures. We'll start with the pass-through entity structure. So you can see here that the best structure really is to have the IC-DISC kind of as a subsidiary of the operating company. So the operating company will pay a commission down to the IC-DISC, and it would take a deduction for that commission payment. So you get the ordinary expense tax benefit at the operating company level. The IC-DISC, as long as it has a valid election in place, is a tax-exempt entity for federal tax purposes. So it does not pay any income tax on that commission that it receives. The IC-DISC then pays the commission out as a dividend back to the operating company, and that's picked up as qualified dividend income at the operating company level. So what is happening is the operating company issues the K-1 to their shareholder or the partner of the pass-through entity, and we have effectively converted ordinary income on that K-1 to qualified dividend income, which is taxed at a reduced tax rate. You'll see that there's basically a circular payment that happens. The operating company pays cash to the IC-DISC. The DISC then pays that cash back to the operating company. So at the end of the day, the cash stays in the operating company and is available for use at the operating company level. So to put some numbers to this example, let's see how that savings benefits, or how we get that savings benefit with the IC-DISC in our structure. So in the left column, we have no IC-DISC in our structure. And let's say we have $100,000 of net income. We get the full 199 cap A deduction of 20%. So our adjusted taxable income is $80,000. We're assuming, again, the highest marginal rate, 37% for an individual taxpayer. So they would pay income tax of $29,600 on that, ultimately that $100,000 of income. Now let's see what happens when we add an IC-DISC into the structure. So we go to the right column. For this example, we'll assume our IC-DISC commission is $10,000. So that reduces our net income now to $90,000. We take our 20% pass-through deduction off of that to get adjusted taxable income of $72,000. Tax at 37%, our tax is $26,640. But now we have to pick that commission income up as a qualified dividend income at the individual level. So we pick that up as dividend income, assume a 20% capital gain tax rate plus 3.8% net investment income tax, and we'll pay $2,380 tax on that $10,000 of dividend income. So when you add that together, our total tax is $29,020. And this is a reduction of $580 from the tax we would have paid without the IC-DISC in our structure. So 580 divided by our $10,000 commission, that's where you see the 5.8% effective tax savings, which is the 29.6 less the 23.8% tax rates from ordinary to capital. So we talked about the pass-through structure. Now let's look at what a structure would look like if our operating company is a C Corp. So in the past, we set up the IC Disc as a subsidiary to the operating company. In a C Corp, that doesn't help primarily because the C Corp doesn't get the benefit of reduced capital gain tax rates that an individual would get. So when we have a C Corp in our structure, it's best to set the IC Disc up as more of a brother-sister relationship with the same common shareholder that you can see on the example here. So our operating company, again, pays the commission out to the IC Disc and takes a deductible expense for that. And then the IC Disc turns around and pays the dividend to its shareholders, and they have qualified dividend income. And what happens here is we've now stripped the earnings. The commission payment has been stripped outside of the operating company, deducted at the operating company level. So we have effectively avoided double taxation on that commission amount. If we would have paid that commission amount directly out as a dividend from the C Corp to its shareholders, the shareholders would recognize the same dividend income, but the C Corp wouldn't be able to deduct the dividend payment. So adding the IC Disc in there gives us that benefit of effectively getting earnings out of the corporation, subject to only a single layer of tax. And if we are to, again, put some numbers and kind of illustrate this out, again, on the left side, we have no IC Disc in our structure. So the corporation pays 21% income tax on the $100,000 of taxable income, and therefore is paying corporate tax of $21,000. That leaves $79,000 available for the corporation to distribute out as a dividend to its shareholders. Tax that 23.8% again. So our dividend tax, $18,802, resulting in total tax of $39,802 on the $100,000 of corporate income. On the right column, we now add a IC Disc into our structure, and again, we'll assume a $10,000 commission. So our taxable income in the corp has been reduced to $90,000, which reduces our corporate tax to $18,900. That leaves us now with $71,100 that we can distribute out of the corporation to the shareholder, and that's subject to tax of $16,922. Now we bring in the $10,000 IC Disc dividend from the commission. That's taxed at $2,380. So our total tax with the IC Disc in the structure is $38,202. And that's a reduction of $1,600 from the tax we would have paid without the IC Disc. And if we take that divided by our commission of $10,000, you'll see our tax savings is 16%. All right, so let's talk about what are the requirements of an IC Disc? Who qualifies for the IC Disc benefit? There are three things that have to be met. One, you have to be what's called an eligible corporation. Second, you have to meet the qualified export receipt requirement. And lastly, you have to meet the qualified asset requirement. And we'll talk about these in more detail. So an eligible corporation, what does that mean? The IC Disc is a separate legal entity, so you have to incorporate a new corporation. And this corporation has to be an eligible corporation, meaning it has to be a C Corp. S Corps don't qualify for the IC Disc. It has to be incorporated in any US state or the District of Columbia. It can only have one class of stock. That stock has to have a minimum par or stated value of $2,500. The corporation has to maintain its own set of books and records. And lastly, but probably most important, the corporation has to file an election with the IRS to be treated as an IC Disc. And this election is due 90 days after the date of incorporation. And that deadline is very important because if you miss that deadline, you won't be able to elect to be treated as an IC-DISC until you get to the following year. Late elections are possible, but the only way to do that is to file a private letter ruling request with the IRS, and that can be a very costly endeavor to do that. So it's important to meet that 90-day election deadline. And if any of these items are inadvertently missed, then you would disqualify your ability to be an IC-DISC. Note that because the IC-DISC is a separate legal entity, it is required to file an annual tax return. And that tax return is filed on a form 1120-IC-DISC. Also, the IC-DISC benefit cannot be received retroactively. So you can only benefit from an IC-DISC from the day the DISC corporation is incorporated going forward. Any qualified export sales you have prior to the incorporation date cannot be brought into the IC-DISC benefit. So again, no retroactive benefits for an IC-DISC. And since we are approaching the end of the calendar year when most companies' tax year will roll over, now is the time to really be thinking about whether an IC-DISC would be beneficial in your structure, because you have the time between now and the end of the year to get it set up so that you can maximize the benefit for all of the 2021 tax year. So the next requirement, the gross receipts requirement, which states that 95% of gross receipts must be qualified export receipts. What this means is that the IC-DISC, the income into the IC-DISC has to be a qualified gross receipt. And pretty much the only income the IC-DISC will receive is the commission income. And so as long as it's commission income on qualified export property, the 95% gross receipt test will most likely be satisfied. So that first item there, the sale, lease, or rental of qualified export property, is what we base our commission on, and will pretty much be our only income of the IC-DISC. So qualified export property, therefore, is a key term, because we can only calculate the commission on the sale, lease, or rental of qualified export property. So what is that? There are 3 tests that you have to meet in order for the property you are selling to be qualified export property. Those 3 tests are the manufacturing test, the destination test, and the fair market value test. And so we'll talk about each of these 3 tests in some more detail. So the first test, the manufacturing test, the property being sold must be manufactured, produced, grown, or extracted in the US by a person other than a DISC. And how we can achieve the manufactured in the US for this purpose is through one of 2 ways. First, it's either substantial transformation of property. So essentially you're taking a raw material and converting it into a finished good, or you're substantially transforming one product into another product. So examples that the Treasury regs give is that you convert steel rods into bolts, or you're converting wood pulp into paper. The second is you're adding value to existing property, which is done through essentially a 20% conversion cost. So here we are improving upon an existing product. So for example, let's say that you are in a t-shirt printing business and you buy a bunch of plain t-shirts that you're going to add printing to. But these t-shirts were manufactured outside the US. So because the t-shirts were manufactured outside the US, reselling the t-shirt would not be export property, because the t-shirt wasn't manufactured in the US. However, by adding printing or graphics to that t-shirt, if you can show that you've added a 20% conversion cost through the cost of supplies or the cost of labor, you can now meet the manufacturing test of being manufactured in the US. And therefore the sale of the printed t-shirts outside the US could potentially qualify as export property. And our second polling question: if a company has an IC disk in place, is it required to use it?
All right, close this poll. Here are the results.
All right. So the one good thing of an IC disk is that if you have it in place, you do not have to use it every year. And commonly I'll see some companies who profits will be up and down as the years go along. And so you can use it in the years when it's beneficial, and in the years when it's not beneficial, you just simply don't pay a commission. Just file essentially an inactive tax return, and then just keep it available for those years when it would be beneficial. And another example might be export sales can be up or down. Some years you might have a lot of export sales, some years maybe not so much. So the benefit of the IC disk is that once you have it in place, you can use it whenever you want, but you can't use it if you don't have it in place. So it's important to think about whether or not you might get a long-term benefit, and if so, it's probably worthwhile to go ahead and have one set up. So we talked about the manufacturing test. Now we'll go on to the destination test, the second test in determining qualified export property. The destination test says that property must be held for sale for direct use outside the US. And for IC disk purposes, the US includes all US territories. So for it to be an export sale, it cannot go to a US territory. It has to go outside the US and its territories. And this can be done, you can either sell directly to a foreign customer with direct delivery outside the US, or let's say you sell to a US address, US customer, or a distributor. As long as that property is ultimately delivered outside the US within 1 year after your sale to the US customer or the distributor, it can still qualify. So let's say you sell it to a distributor, and that distributor exports your product, and they export it and deliver it outside the US within 1 year. It would qualify for the destination test. Or for example, you sell it to a US customer, but that US customer is ultimately going to use that property at a location outside the US. As long as they delivered outside the US within 1 year, that would still qualify. However, the property cannot be used or further manufactured in any way prior to being delivered outside the US. If there is any use of the property in the US prior to export, then you would fail the destination test and you would not qualify for the IC disk benefit on that sale. Also, an important thing to note is that there is a proof of compliance, and that proof lies with the seller. So if the IRS were to ever audit the IC disk, you would have to prove to the IRS that the property was exported accordingly. And so if you aren't the party doing the exporting, you would want to make sure that you can get access to the export documentation in case the IRS were to ever audit the IC disk. If you cannot prove that the property was exported to the satisfaction of the IRS, then you would not meet the destination test, and that sale would not qualify for the IC disk benefit. There are some instances where ultimate use is deemed to be in the US. This can happen if export property is reimported into the US within 3 years of the original sale. This can happen if the property export is incorporated as a component part of a second product that's resold in the US. This can happen if, under reasonable person standard, you have reason to believe that the property would ultimately be used in the US by the buyer, or if you have an understanding at the time that you sell the property that the buyer is going to use that property in the US, then that would count as use in the US. But there are exceptions to these rules. The exceptions are if you sell to a foreign retailer. It's possible, say, if you're on the border, that you sell something into Canada for retail, that it might be bought by a person who's vacationing in Canada, buys it and brings it back into the US. But a sale to a retailer outside the US is deemed to ultimately be used outside the US. And then for component parts, if you have a component part that's incorporated into a second product, and that product is available on a worldwide market, not a market specifically the US, but on a worldwide market, then your sale is deemed to be used outside the US. An example is, say you're a US manufacturing company, you make water valves, and you export these water valves to a European manufacturer. That manufacturer is going to incorporate that valve into an appliance, and then that appliance is available for anyone in the world. And it could be that someone in the US buys that appliance and it comes into the US. Because it's available on a worldwide market, your sale of the water valve outside the US would still qualify for the IC disc. And then the last test to determine qualified export property is the fair market value test. The fair market value test states that no more than 50% of the fair market value of the export property can be attributed to imported materials. And for this purpose, the fair market value of the export property would be the sales price to an unrelated customer. And the value of the imported materials would be the dutiable value claimed at customs. So let's go back to that t-shirt example that we used a little bit earlier. And so let's say you are importing t-shirts, or you're buying t-shirts that were previously imported, and you're buying those at a cost of $5 per shirt. And then you add your printing to that t-shirt and you resell that shirt for $20 to the end customer. In this case, $5 is our imported materials, $20 is the fair market value of the property being exported. So if we take 5 divided by 20, that gives us 25%, and therefore this test would be met. Let's say instead we only resell that shirt for $8. So now we have $5 imported materials divided by $8 of the export fair market value of the export property. Well, 5 divided by 8 is greater than 50%. So in that example, we would not meet the fair market value test. All right, so getting back to the IC disc qualifications, to be an IC disc, we talked about the corporate requirements, we talked about the qualified receipts requirement. The last one is the qualified assets requirement. 95% of the assets of the IC disc must be qualified assets. And on the screen, you'll see what these can include. This isn't an all-inclusive list. But the one to really note is the second item there, which is the commission receivable. So what we do with the IC disc is we accrue a receivable, which is the commission to be paid into the IC disc. So the IC disc has a commission receivable on its books. And this will typically be the largest asset of the IC disc books. And as long as that is 95% of our total assets, we would meet the qualified asset test. So pretty much the only assets you typically see in an IC disc is a cash account to receive and distribute the commission, and the commission receivable account. The commission receivable is a qualified asset. However, cash is not a qualified asset beyond the reasonable need for cash to pay any expenses of the IC disc or for your $2,500 capitalization. So it's important to really look at what your balance sheet is and make sure that you are meeting the qualified asset requirement. And note that this test really only needs to be met on the last day of the year. So you can fail the qualified asset test for 364 days of the year, but on that 365th day, that last day, you have to make sure that the test is met. All right, so moving on to the commission calculation. We talk a lot about the IC disc receiving the commission, distributing the commission, but what is this commission and how do we determine the commission amount? So the Treasury regs give basically 3 acceptable methods of calculating a commission. And we'll talk about these, we'll give an example to illustrate these a little bit later. But the acceptable methods are 50% of what's called your combined taxable income, or CTI for short. You can take 4% of your gross receipts, your gross export receipts. And then there's a third method under marginal costing. Marginal costing is basically an alternative way to calculate your combined taxable income. There's what is called a no loss rule. The no loss rule means that your commission cannot exceed your CTI. So your CTI is basically the cap of what your commission can be. But as with everything in the tax world, there's an exception to this rule. And if we use marginal costing, there's a special 4% rule that could allow us to take a commission even though our CTI is negative. So combined taxable income, to calculate that, simply we take our export sale, our qualified export sale, we subtract from that the cost of sale that is associated with that qualified export sale. And then we subtract from that allocation of SG&A costs. The SG&A costs you can kind of put into 3 buckets. Specific costs are specific for export transactions, specific for non-export transactions, and then anything that can't be specified as export or non-export. Those non-specified costs then get ratably allocated between export and non-export. So we subtract, we start with our sales, subtract our cost of sale, our allocation of SG&A costs. The end result then is our combined taxable income. So basically, we're calculating what is our net income on the export sale. Another thing to note with the IC disc is that the commission is by default calculated on a transaction by transaction basis, or what we call a T by T method. And this is really good because it allows you to maximize your commission benefit, because you can take the best method on a per transaction basis. So sometimes the 50% method is beneficial. Sometimes the 4% method might be more beneficial, depending on what your gross profit is of the transaction. So you can look at each transaction individually, apply the best method, and really maximize your commission. It's possible, if you want to, you can group transactions by products or product lines. And sometimes that can help you maximize the commission. Note that if you group them, then that would apply to all transactions within that product. And then any transactions that fall outside that group product would remain on the T by T method unless you choose to group those by another product method. So there's really a lot of ways through the transaction by transaction method and product groupings to try to maximize the commission amount. And really by maximizing the commission amount, you're maximizing your tax savings from the IC disc. So marginal costing, as I mentioned before, is an alternative way to calculate your combined taxable income. And what you do is you either take your marginal profit, which is your gross receipts less your cost of goods sold, or you take your gross receipts and you multiply it by what's called an overall profit percentage, or OPP for short. The overall profit percentage is, in general, the taxable income of the related supplier divided by the gross receipts of the related supplier. And you can do that overall, you can do that on a per product method, but your gross receipts multiplied by your OPP, or your gross receipts less your cost of goods sold, whatever the lower amount is, that is your CTI under the marginal costing method. And then your commission would be 50% of this alternative CTI. So we'll go through an illustration of each of these methods to kind of make it a little bit easier maybe to understand how they're calculated and how you can benefit from the T by T method. So we have 4 transactions here. We'll start with number 1. We have $1,000 of gross receipts, $200 cost of goods sold to give us an $800 gross profit. $500 is our SG&A to give us $300 is our combined taxable income. And then for this example, we will assume that our overall profit percentage is 10%. So the 4 methods we talked about, the 50% method, we take 50% of our combined taxable income. So 300 multiplied by 50% gives us $150. That would be our commission under the 50% method. The gross receipts method, 4% of $1,000 is $40. So under the 4% gross receipts method, our commission would be $40. Then we go to the marginal costing method. So again, marginal costing is an alternative CTI calculation. So we take the lower of our gross profit, which is $800, or the gross receipts multiplied by our OPP, which is 1,000 multiplied by 10%, $100. So we take the lesser of $800 or $100. So it'd be $100 and multiply that by 50%. And that gives us $50. The special 4% in this case doesn't apply because our commission doesn't exceed CTI. So our best method is the 50% method, which would be $150. Now we go to transaction 2. You'll see our CTIs come down here and our gross profits come down here. So under the 50% method, $50 is our CTI times 50%, $25. Our 4% method stays at $40. Our marginal costing method, see now that dropped to $35 because our gross profit in this example of $70 is lower than our OPP profit. So $70 multiplied by 50% gives us the $35 under the marginal costing method. So in this example, the 4% gross receipts method gives us the best result, and that is the method we'll use for transaction 2. Moving over to transaction 3, our CTI is $80, so that gives us a $40 commission under the 50% method. Again, our 4% method stays at $40, 4% multiplied by $1,000. And our marginal costing is $50, which is the 50% of the $100 OPP. So the marginal costing now is the higher of the methods available. So we would use the marginal costing method for transaction 3 and get a $50 commission on this transaction. Now we go to the last one, transaction 4. And on this one, we lost money on this transaction. We had negative CTI, or a loss of $450. So because we have no CTI under the no loss rule, we do not get a commission under the 50% method or the 4% method. But we still have the marginal costing method that could potentially give us a commission. So again, our gross profit is $50. $50 is less than our OPP profit of $100. So under the marginal costing method, we have a $25 commission. But now we can bring the special 4% method in. And the special 4% is basically the same as the 4% gross receipts method. However, for this purpose, our CTI is our OPP profit. So we have $40 under the 4% method, 4% times $1,000. But our OPP profit of $100 is greater than our commission, so we can get the full $40 commission under the special 4% method. And if we add all these up for transaction 1, 2, 3, and 4, our total commission is $280. Now, if we look at the far right column, if we were to group all of these together, you'll see that our commission, we would get $200 under the marginal costing method. And so by grouping everything together, our commission is limited to $200. But by being able to separate the transactions out and by using the best method on a per transaction basis, we increase our commission by 40% to $280. So that's where you can really see the ability to maximize your ICDIS commission through the per transaction method. And that brings us to our third polling question. So let's say US manufacturer sells property to an unrelated distributor on July 1st of 2017. The distributor, B, resells that property as is to a foreign customer and exports the property on September the 1st, 2017. So can both A, the manufacturer, and B, the distributor, benefit from an ICDIS on this transaction?
All right, go ahead and answer that poll for me. All right, we're going to close this poll here. And here are the results.
All right, so we got 72% that say yes, and that is the correct answer. So both A and B can benefit from the ICDIS on these sales. The key is that the property was sold as is, so that means it wasn't used or further manufactured in the US. And 2, the second sale occurred within 1 year of the first sale. So that means A can qualify on B's sale.
All right, you should have control.
All right, thank you. Okay, so just kind of a few wrap-up items in talking about the ICDIS and the commission. As we mentioned, there is a cash transaction that has to take place with the commission. So the commission is ultimately calculated based on the taxable income of the related supplier. But a lot of the times, especially when you have until September, potentially October to file tax returns, it might be a while before you can figure out that commission. Well, the IRS, the Treasury regs say you have to pay an estimated commission within 60 days after year end. So for a calendar year taxpayer, basically you have to pay the estimated commission by the end of February. But you might not know what your total commission is because the tax return of the related supplier might not be completed in February. So then you have what's called a true-up commission payment, and that payment is due within 90 days from the date you determine that amount. So the estimated commission plus the true-up commission would then equal your total commission. So you can have maybe 2 commission transactions per year to pay the full commission amount. But these payment deadlines, the 60-day and the 90-day rule, are very important, because as long as you meet the payment deadlines, the commission receivable that you accrue at the end of the year is a qualified asset. If you do not meet the payment deadlines, then that commission receivable is not a qualified asset and will most likely disqualify the DISC, thereby negating the tax benefit you would receive from an IC DISC. So it's important to make sure that the payment deadlines are met. Note though that even if you do miss them, there is relief typically available to help re-qualify the IC DISC if you disqualify it. We won't really talk about that today, but there is relief available. Tax deferral. We talked at the beginning, a secondary benefit of an IC DISC is tax deferral. So there's no requirement that the IC DISC has to distribute the commission it receives out as a dividend. But there are some limitations. So one, we have to meet the qualified asset test on the last day of the year, like we mentioned. So effectively, in order to do that, you have to convert cash, which is a non-qualified asset, into a qualified asset. And there are some ways this can be done, but what's important to note is that you need to carefully plan if you do want to take advantage of the deferral through the IC DISC, so that you don't inadvertently disqualify the DISC. Second is that the deferral is only limited to commissions related to the first $10 million of qualified export sales. So any commission associated with qualified export sales beyond $10 million is deemed to be distributed in the current year, regardless of whether an actual distribution takes place. And then there are some other items that aren't necessarily commonly occurring that could cause a deemed dividend. Primarily the $10 million rule is the one that we see the most. And as mentioned, there is an interest charge that applies to any deferral of tax. That basically you take the T-bill rate that's published by the Treasury, and you multiply that by the tax that you're deferring, and that would be your interest charge. The 2019 interest rate, I believe, was about 2%, a little over 2%. My guess is that with the recent cuts in the interest rate, that the T-bill rate will be dropping. So you can defer tax at a pretty cheap cost. And the last thing I want to mention with IC DISC is state tax issues. So everything we talked about relates to a federal tax benefit. Note that a lot of states do not follow federal IC DISC treatment, and they will actually treat the IC DISC as a normal corporation, meaning they would subject the IC DISC entity itself to income tax at the state level, even though you don't pay tax at the federal level. The state issues can get very confusing. A lot of states are really silent on this issue. So when setting up an IC DISC, you really should give careful thought to the state that you're located in, or the state that you'll be doing business in, to make sure that your federal benefit is not wiped out at the state level. Okay, so that's the IC DISC, and I don't think, Amy, that Chris was able to join today. Is that correct?
I don't believe so, but let me just check one thing really quick. No, he wasn't able to.
Okay, so Chris Stroh, a colleague of mine, was going to present on the FDII benefit, but unfortunately he wasn't able to join today. So I apologize. I will try to explain this as best I can. I'll probably miss a few items that Chris would have been able to pick up on. So I will do my best, but please feel free to send me questions afterwards, and we can make sure if you have any questions on FDII, we can get those answered. But essentially, FDII, foreign derived intangible income, is a new tax benefit that was created under the 2018 Tax Cuts and Jobs Act. So this is created under Internal Revenue Code section 250, and it applies primarily to C corporations. Pass-through entities really aren't eligible for this deduction. And what happens is, much like an IC disc, you create a reduced tax rate. You create kind of a net income on your export sales, and those export sales are taxed at an effective tax rate of 13.125% rather than the 21% normal tax rate. And the reduced tax rate is achieved by taking a deduction on your corporate tax return. Kind of similar to, there was the old domestic production activities deduction that you could take prior to the TCJA. So now we get a deduction for export sales under FDII to reduce our effective tax rate. Oops, sorry, I'm trying to advance here. Okay. So this is just a statement of the new tax code that talks about section 250, and that the deduction is only available to domestic C corporations, and it allows you a deduction to get you to the reduced effective tax rate. And note that the deduction percentage decreases after 2025. So you get the, if I go back here, an effective rate of 13.125%. After 2025, that effective rate will go up a little bit, but it will still be below the 21%. And I think we have our last polling question. So going back to DIS, our last question: a U.S. manufacturer sells property to a U.S. person. The U.S. person further manufactures the property and then exports it. So will the sale by A, the manufacturer, count as qualified export property?
All right, that poll is now open. All right, we're going to close this. Here are the results.
Okay. So about a 50-50 split. So the sale by A does not count as qualified export property. And the primary reason here is that B further manufactured that property. So in this example, B would be able to take the benefit for an IC disc because they manufactured in the US, but A no longer receives that benefit because of the further use provision.
All right, you should have control.
All right. Let's see. Okay. So for FDII, going back topics again, basically what happens is you do a 4-step calculation to determine what your deduction amount is. And you kind of start with similar to an IC disc, because you calculate your what's your deduction eligible income. So this is effectively overall kind of what is your net income from your, let's say, your trade or business. Then you determine what's the foreign portion of that deduction eligible income. So what of my sales are qualified sales for FDII purposes? Then you calculate what's called a deemed intangible income. So intangible income basically you take your qualified business asset investment, QBAI or QBI for short, and you take 10% of that amount. So the QBI would be your fixed assets effectively depreciated on a straight line method versus the maker's method, which is normally available for income tax purposes. And you take your net basis in those assets, multiply that by 10%, and you kind of subtract that off your deduction eligible income. And then once you get that, then you calculate your FDII amount, which gives you your deduction amount that you can take on your tax return, which is primarily related to your export sales. Chris would be able to walk through the example, and we only have a couple of minutes left, so I'll kind of skip over the example showing how you get to the actual deduction amount, and instead we'll talk about what qualifying income is. So qualifying income for FDII purposes is fairly similar to what it is for an IC disc. However, it's a little bit more liberal in that for FDII purposes, more sales are eligible that wouldn't be eligible for an IC disc purpose. So we have some common themes where foreign use means is you have to use the property outside the US. But note that in a FDII context, you have more things. So like you could provide services in the US with respect to property located outside the US, and that would qualify. So for IC disc, services would only qualify if it was architectural or engineering services provided for construction projects outside the US. But for FDII, if you're providing services in the US for a foreign customer, it doesn't matter what the services that you're providing, that could potentially qualify for the for the FDII deduction. So you get a little bit more lenience in what qualifies. Also, the further use would not necessarily eliminate the benefit for FDII purposes. So I kind of rushed through that, and I apologize for that. But if there are any questions, I can make sure those can get addressed and we can get answers to you specifically on the FDII piece, but also on the IC disc. So with that, I know we're right up at 12 o'clock Mountain Time, but I'm happy to take any questions.
All right, we do have just a few minutes. If you want to ask a question, you can use the chat feature or the Q&A. I don't have anything in there right now. All right, well, with that being said, please feel free to reach out to Mark or Chris directly, or you can reach out to us on our website. And we just thank you so much all for attending, and thank you to Mark for presenting.
All right, yeah, thank you, Amy, and thank you everyone for your time and attendance today, and hope everyone enjoys the rest of their day.
Have a great day, guys.